What is a CDO, Collateralized Debt Obligation? Have you ever wondered how financial institutions manage risk while creating investment opportunities? One key tool they use is called a Collateralized Debt Obligation, or CDO. So what exactly is a CDO? A CDO is a complex financial product that takes various types of debt, such as mortgages, bonds, or loans, and pools them together. This pooled debt is then divided into different layers, known as tranches, which are sold to investors. Each tranche has its own level of risk and potential return, allowing investors to choose what suits them best. To understand how a CDO works, let's break down its basic structure. First, a special purpose entity is created to gather a portfolio of underlying assets. These assets can include mortgage-backed securities, commercial real estate bonds, and corporate loans. Next, this entity issues bonds in exchange for cash, which is then used to purchase the portfolio of assets. These bonds are structured into layers or tranches. The senior tranches are the least risky and receive payments first from the cash flows generated by the underlying assets. On the other hand, junior tranches and equity tranches come next, with equity tranches carrying the highest risk and potential for loss. CDOs have been widely used in financial markets to create new investment opportunities and manage risk. They gained notoriety during the financial crisis of 2007 to 2009, especially those backed by subprime mortgages. Despite the risks, CDOs remain as a tool for financial institutions to diversify their portfolios and manage risk effectively. Now, let's connect this to the Goldman Sachs ABACUS controversy. The ABACUS deal involved creating a synthetic CDO that allowed investors to bet on the performance of mortgage-backed securities without actually owning them. This raised serious questions about transparency and fairness in financial markets. The controversy highlighted the need for regulation and ethical practices in structured finance. From a capitalist viewpoint, CDOs representing a method of managing risk and allocating capital. They allow investors to engage in complex financial transactions that can generate profits while managing risk. However, the ABACUS case also shows how financial instruments can be misused if not properly regulated. Understanding CDOs is essential for grasping the complexities of modern finance and the lessons learned from past events.